It's good to be with you. Thanks for that kind introduction, and thank you to the Indiana corn and soybean folks for sponsoring this morning's session. We appreciate your support in all we do here. Let's get started. There's a lot of ground to cover and a short time to get there. We're dealing with lots more product. This is per capita consumption is rising again. We can see we've reduced per capita consumption for several years. Does that mean demand is rising again and the demand was bad for a few years? The answer is no, because consumption is not demand. Consumption is really driven by production, and the reason we had production falling for several years was when costs went up, and I would lay that right squarely on the ethanol program that drove corn prices up and grain prices up that caused some issues, and then of course the 2012 drought with higher costs. We cannot afford to bring as much product to the marketplace as we did prior to that. But those costs have gone down. We'll talk about that in a minute. And we saw a big jump, about 3.5% in total per capita meat and poultry offerings last year. That's going to grow slightly for the next 2 years, in our opinion. We're not going to get back up to the record set in 2006, which was about 220 pounds. We're going to be about 214. The question is still hanging out there of whether we're going to go back to 220 pounds. My thought right now is we probably won't, but we're certainly growing again. Now, that's the total. But if we look at pork, if you ask me what the per capita consumption of pork is going to be for the next 10 years, I'll take 50 pounds and give you the field. That's kind of the way it's been. The only time we've been short of that in the last 30 years is those cost-induced shortages during the 2008, 9, 10, 11, 12 period. We're going right back to 50. We think that we're going to stay right in that range for the foreseeable future. So we've not increased consumption. But again, I'll tell you, that doesn't mean we haven't increased demand, because there are two aspects of demand, quantity and price. And people have revealed that they are willing to pay for pork if we bring them what they want. And I think that's a challenge that we have in front of us. We've had record retail prices the last few years. And so we know that they will pay for it if we do bring them what they want. On a total production side, total output, new records in 16, 17, and 18. It's a good thing we have a growing population and generally growing exports. And we'll talk about the export market in a bit. I think that's going to be one of our challenges over the next few years, but certainly a lot of product available to us. If we look on the grain side, you're going to see a common theme here. World stocks of corn are record high. World production is record high. World consumption is record high. And notice that in about 2003 or 4, we increased the rate of increase of world corn production and consumption pretty dramatically. You do that when you raise the price of a product and attract a lot of worldwide competition. Brazil used to never be a factor in the corn market. The corn market in the early 2000s was the United States, China, Argentina, and South Africa. That was the only exporters of corn in the world. When we jacked prices up with the ethanol program, some people said, gee, we ought to get in this business. And so we've seen corn production rise at a much faster clip over the last 15 years or so than we did prior to that. Record stocks of corn. When we look at the U.S. crop, this is the November WASDE. Of course, we have a record crop this year, 175.3 bushels per acre, over 15 billion bushels. You know, it reminds me, when I was on faculty, at Missouri in the late 1980s, we used to talk about a great corn crop was 8 billion bushels. And now we're raising 15 billion bushels on virtually the same acreage. Feed and residual usage up this year from last significantly, according to USDA. So is ethanol up slightly, but you're not going to see that number change very much. We have a cadre of ethanol plants out there. They're basically going to run full. From now on, in and out a little bit based on gasoline and corn prices, but they're going to be somewhere in this 5.3 billion bushel of corn. Exports have grown back from where they were in 2014-15. That's going to be the number that really drives the corn market this year to see what exports are going to be. But the carryover at 2.4 billion, or 16.4% of production of usage, is as high as it's been in 20 years. So we see some pressure here with the USDA's forecast price in the $3 range, $3.25. We think that we're going to see a lot of corn. This is CBOT futures, our forecast. You can see here our forecast going out through the end of next year, right at $3.50 on the futures markets. Depending on what your basis is, you're going to be somewhere in that $3 to $3.50 range. And we think we're going to see a whole lot of that over the next 4 or 5 years, except for when we have drought conditions and a short crop. Low threes are going to be a good number. We'll come back to that in a minute. We look at soybeans. Pardon me. This is wheat stocks. Again, record wheat production, record wheat consumption, record high wheat stocks. Now, in Indiana, you're a little more sensitive to that than the folks in Iowa are. In Iowa, you put a wheat chart up and they go, why is that up there? The reason that's up there is because in most parts of the world, wheat is an important feed ingredient. And so wheat is important in the feed mix as well, and it certainly is in the Eastern Corn Belt and the Southeast in those off-season time periods when wheat is harvested. And so this is going to keep a lid on corn prices. If we have these kind of world wheat stocks, we can't expect corn to rally very much unless these tighten somewhat. On the soybean side, record production, record consumption, very near record world stocks. Down slightly from 2 years ago, but still very close to those levels. You see kind of a recurring theme here, record large, record large. It's just all. Agriculture is very good at producing things, no question about it. And we are certainly back in that mode now. Now, there's some benefits to that, and the benefits in that is a carry out of 480 million bushels of soybeans, almost 12% of production. You can see that's not quite the kind of increase we saw on the corn side. And of course, because of world demand and this burgeoning usage of soybeans, it just doesn't seem to have any end. We still have pretty good prices on beans up in the the $8.50 to $9 to $10 range. Soybean meal price though, somewhere in the low 300s. If you look at the board right now, I think every contract is in the 310 to 315, 316 range. And so this is going to be a paradigm you see a lot of, in my opinion, over the next 3 to 5 years. 3 to 350 corn, $300 to $350 bean meal. And if you ever get them to the bottom of those ranges, somewhere in the $3 range on corn or $300 range on bean meal, and you can book that, I don't think you're hardly ever going to leave much money on the table because I don't see a lot of bottom side in that. There is some top side risk on that, especially when you look in the off year. And so right now, when we look at this coming year, we think that we're home pretty much on production costs. And to be very honest, I would be looking at your 17-18 crop needs or feed needs and saying, what kind of coverage can we take on at least part of that supply, given the price ranges where the futures markets are trading at this point. Here's our forecast for bean meal. You can see between 320 and 370, kind of as far as we can see out to the end of 2017. What does that mean for costs? Iowa State University's model for farrow to finish cost of production, and by the way, it was revised 2 years ago by Dr. Lee Schultz at Iowa State, and this number used to represent kind of the average farrow to finish operation. I think it represents now probably about the best of farrow to finish operation from a cost of production standpoint. The people I've talked to said, boy, that's pretty competitive. But our forecast out for 2017 right now is $65 and change on a carcass weight basis for cost of production based on this model. And again, it represents probably the best, where at one time we would say the best producers are $5 lower than the number we had up there. We would say the average producer is probably $3 to $5 higher than this, so in the mid to upper 60s on cost of production. If we look on the demand side, we have an economy that is kind of muddling along. There was a lot of press when the third quarter GDP growth was released a few weeks ago, up 2.8%. Now that's increase from second quarter to third quarter, the annualized rate of the increase in GDP. That would be the green bar here. I use year-over-year comparisons where we compare the third quarter of this year to the third quarter of last year, and that's the red bars here instead of the green line. And to me, that's a more valid comparison because you're capturing basically the same seasonal impacts in both years. We're going from the second quarter to the third quarter of a year. The seasonal influencers are quite different. If you look at that one, this number was up only 1.4%. So we have GDP that's not growing very quickly. The jury is certainly still out about what the new administration might mean for business. Obviously, the stock markets have voted in favor of the election of President-elect Trump. They certainly have set new records on several occasions since then. Whether that translates into a much stronger economy from a growth standpoint remains to be seen, but still the economy is not weak. It's not particularly robust, but it's certainly not weak, and so we think that's probably okay for meat demand. It's one of those things that's not going to hurt us much. Now, here's another measure that we use, real personal disposable income per capita. This is how much money do our citizens have per person after they pay their taxes to go do other things with. And we can see that the year-over-year growth of that has been declining virtually all year. Now, it's going to end up very close to this 2% mark. Last year, we averaged about 2.6%, which is one of the best years we've had in the last 20 or so. But you can see this downtrend is somewhat concerning. We'll see how it pans out to the end of the year here and as we get into 2017, but still a positive number. Again, nothing that I would consider robust. When we put those together in consumers' actual behavior in buying meat and poultry, real per capita expenditures is a measure of demand strength that I use and that the Pork Board uses on my recommendation. It basically says how many dollars in real dollars, and these are 2014 dollars, do consumers spend, and we have beef, pork, chicken here. We do not include turkey. I know there's a lot of turkey interest in Indiana. We're not intentional. Well, we are intentionally excluding you, but we have a good reason, and that is that USDA does not provide us a very good retail price of turkey. The only price we get from USDA is a whole bird price. We know that that leaves out all of the value adding that you've done with different cuts of turkey, and we think it's quite misleading. So we just use these three species, and you can see that as we compare to history, we've come off some very good numbers in 14-15. We're down about 3.5% so far year to date. But I would point out that we're comparing those to remarkably strong numbers a year ago. So you have to watch the denominator in these year-over-year comparisons. What's going to happen here is we're going to get into 17 and start comparing to 16, and the numbers are going to look quite a bit better, in my opinion. I think the year-over-year numbers will change because we don't have this huge denominator that we had last year. Just remarkable strength coming off the PEDV scare of 2014. And very strong retail prices. You had very strong beef prices, which are part of the driver of this a year ago. So I'm not terribly concerned about this. Still on an uptrend out of the depths of the recession here. We've challenged the highs that we set back in 2004 when the Atkins diet pushed meat demand higher. But still, I think we're in pretty good shape here, even though we have a negative number for the year. Now, when we look at the separate species, here's pork, chicken, all fresh beef, and you can see that pork has really fared better relative to a year ago than the other species have. We'll get December exports. As a matter of fact, they're being released this morning. We'll get the December export report, which will have October data in it, and that's the last piece of information that goes into computing these on a monthly basis. So next week we'll have some October information out. We expect those numbers to be close to last year, just as they have been, and part of that is because retail prices have not come down significantly. Now, many of us in this room think that that's a lousy thing, but it's having people willing to pay money for your product at the end of the chain is important, because no dollar ever gets back to you that doesn't go through a grocery store or a restaurant at some point. And if the number of dollars goes down there, it's very difficult to increase them back up to where they used to be. I don't have a problem with retail prices staying sticky because it gives room for wholesale prices and hog prices to recover that would be more difficult to accomplish if those retail prices had come down. The export side has been a challenge for the last couple of years. It certainly was last year with delisting of plants and with our problems with the West Coast ports. More concerning to me is the long-term pattern of exports. We had a decade of steady growth of exports, punctuated by a couple of big swings to China in 2008 and again in 2011. But since 2010, we've basically been flat on exports. And if I put beef up here, it would look the same. If I put chicken up here, it looks the same. The low-hanging fruit of U.S. meat and poultry export growth has been picked. Now, there are some possibilities out there. We have a Trans-Pacific Partnership deal that's signed. I don't know if we're going to get it ratified and signed on our end. It doesn't look very promising at the moment. That would open up the lower value market in Japan to U.S. products, because it would basically over time kind of dismantle the gate price system, or at least make it less effective. That would be a great boon for us. It would open up Vietnam. It would probably bring China to the table on reducing tariffs at some point. But I'm not sure we're going to get it ratified and get it into effect. It looks very doubtful at this point. And so if that's the case, we don't have any new real free trade agreements being enacted other than the full implementation of the Korean Free Trade Agreement, which was signed about 3 years ago. So growth on the export side is going to be a little tough. We did have some growth in August. September was not quite as good. We think the rest of the year will be above that next year. We'll end up the year at plus 3 or 4%. Right now, we're expecting about that level of growth in 2017. The caveat I would offer on that is that some of you know Brett Stewart with Global Agri-Trends. Brett has forgotten more about trade than I know, and he has 1% in his forecast for next year. And that concerns us a little bit when somebody with Brett's knowledge and reputation is that kind of cool on export growth. If we look at individual markets, of course, the one that got all the attention earlier this year was China, and deservedly so. We had this big increase in China in April and May. Basically, the futures market said, aha, we're back to 2008 and 2011, and they bid in substantial premiums into the futures market for a couple of months. I hope all of you took advantage of that to price your hogs for the year, because it was a real opportunity, and it's one of those that we ought to always be watching for. We didn't ever think that was going to probably to end up in one of these 2008 or 2011 surges, and the reason we didn't is because there is substantial competition from the EU. China became the world's largest importer of pork this year. They passed Japan. The only problem is we're not getting all that, even the majority of that business. EU has about 70 to 75% market share in China. They have a price advantage on us because of the strength of the dollar, and that's the next point I'll make here. This dollar is strong, and so we didn't think that our growth to China was probably sustainable, and certainly it wasn't. They've dropped back down to more normal kind of levels in the last few months. The dollar, of course, strengthened in 2014, caused lots of havoc during that year. It's been in this trading range until just a couple of weeks ago. Gee, almost the same time as the election. And it's broken out the top side of this 2-year-old trading range. That's a concern to us. Technically, if normally you see these well-established trading ranges, if you break out of one side of them, you go above that trading range by the width of the range, which would put the dollar up here at about 107, one of its highest rates in about 30 years. That would give us a bigger disadvantage selling in export markets. So why has this happened? Remember, the futures market is looking into the future, trying to predict what's going to happen. There's been a lot of talk by Mr. Trump about doing some stimulative effects on the economy, try to get the economy going at a more robust rate. Back to my point about GDP. He's talked about tax cuts. He's talked about government spending programs on infrastructure, a lot of those kind of things which you normally do to stimulate the economy. If you stimulate the economy, you probably set a fire under the inflation rate, and Mrs. Yellen and the Board of Governors at the Federal Reserve is not going to let the inflation rate get out of hand. And so you're probably going to raise interest rates, and when you raise interest rates, and by the way, interest rates are still close enough to zero, about the only thing they can do is go up, and the Federal Reserve is looking for a reason to raise interest rates, and if you raise interest rates, guess what? You strengthen the dollar. So that's the chain that gets you to a stronger dollar with the election of President Trump. Now, whether that all pans out, we'll see, but when you've got a well-established range and you break out of it, that's usually a significant development in these markets. Okay, enough on the demand side. Demand is still pretty good, not great. Export demand is still decent, not great. We think we're going to muddle along here with a little bit of growth over the next year or so on exports. We think that demand will probably, on a year-over-year basis, the comparisons will get better as we go into 2017 because we won't be using the robust year of 15 as the denominator on those year-over-year comparisons. Let's go on to supplies. First, we have a lot of product in storage. This is cold storage. At the end of October, you can see close to the highest of the last 5 years. And that's really actually good news because it was down 1% because we spent most of this year of the 4 major species above the highest level they've been at in the last 5 years. If we look at just the pork items there, pork stocks were down 0.9%. More importantly, this seasonal drawdown between September and the end of October was about 60 million pounds more than normal. That's pretty remarkable because you remember we started the big slaughter weeks in September and have been running them ever since then, setting records on production in many weeks, and yet we pulled cold storage stocks down more than normal. I think that's a pretty remarkable occurrence. I think we've done a great job of getting product moved, so we didn't get it backed up here. Hams, kind of the same thing, the ham drawdown. We have very large stocks of hams, but the drawdown was normal. On ribs, again, we build stocks at this time of year. That was a very normal building. Again, close to the highest we've been in the last 5 years. And other pork cuts, much lower. Now, this is kind of a catch-all category, but the reason I put these four up here, if you add them up, they're about 60%. These three cuts are about 60% of the total, and they normally run that way. So these three cuts normally are the important ones. The trouble is we can't see the, there we go. Yeah, thank you. It's more important to see the slides than to see me. All right? I'm sure of that. If we look at profits based on the cost we saw a while ago and what the futures market's saying right now, we have moved to the profit side just barely. Next year's definitely negative at negative $8. If we look at where we were at Pork Expo time, that was right when the big rally in futures happened due to the surge of exports to China. We had 2016 profits at $8.50 there. They're down about $5 a head from that. Okay, let's talk about what's been happening so far this fall. The week of September 23rd was a shocker. When we look back on this and we see we broke above slaughter capacity, larger than what we expected. The blue smooth line here was our forecast. Thought, oh man, this is going to be a real wreck because we already had slaughter at or above capacity levels for about 6 weeks starting in November. Of course, the hurricane came along 2 weeks later that drove us the other way. And, you know, if there's anything you don't want when you got lots of pigs is something that leaves some of them alive at the end of the week that shouldn't have been. And that's kind of what we had in this situation. We shut the plants down on the East Coast for about 3 days, or in the Carolinas. The back hogs up, lots of logistical problems. And so we moved forward from that, and now, after the disruptions lasted for a while, we actually had a surge in the western corn belt because of a plant that operated on Sunday 2 weeks later. There were some shutdowns again in North Carolina the week before that. And so we've been bouncing around here, but we had records of 2.54 and 2.53. And then, of course, last week, and I'll get to that in a minute, set a new record of 2.54 million per week, the largest we've ever slaughtered in the United States. Now, how does this fit with the September Hogs and Pigs report? Well, the September Hogs and Pigs report said we had a lot of hogs coming. These numbers were pretty big. They were bigger than analysts expected. We've actually ran just a few more than that, but I think that is a market weight and market timing issue that we'll talk about in a minute. Our concerns were still that USDA may be underestimating the pig crop and underestimating litter sizes going forward. We'll talk about that as well. On the breeding herd, USDA had about 1% growth, 0.6%. We suspect that the December report is going to show us up 1% from a year ago. There are still sow barns being built. We're not aware of very many sows that have been shipped, and if you look at sow slaughter, there hasn't been any wholesale liquidation of sow farms as prices have fallen this fall. It's been a pretty normal rate of sow slaughter as we've gone forward. So we think the breeding herd is still growing, will probably grow through next year, especially with the new plants coming on. Litters per breeding animal. The last 2 or 3 years have gone downward. This number is the PEDV year, and for the life of me, I have no idea how USDA justifies PEDV affecting litters per breeding animal quite that much. We know that it impacted some rebreeding, but USDA adjusted litters farrowed in order to account for the short pig crop that year instead of changing the litter size. And I'll get more into that in a minute, but I think the important thing is this has been trending downward. Why has it done that? My thought is it's probably the productivity impacts on those farms that are transitioning from crates over to pens. We know that pens can be efficient, but during that process it's usually pretty difficult. And this is the time period when Smithfield and a lot of others were shifting farms over to pen gestation. Notice the observation for this year is going to be about the same as last year and a little above this new trend line, so we think we might be kind of through the worst of that. We're going to use 1.96 litters per animal in the breeding herd for the next couple of years. That puts us, we've had this number all year that we were going to farrow 11.793 million litters. USDA was 300,000 behind that back in June. They kept getting closer, and now they're at 11,775. We can buy that. One of the problems USDA's had is they've been systematically missing the pig crop low for 2 years. It's averaged about 2.4% during that time period. I told my friend Dan Carestis at USDA, who runs the group that does the pig report, and I said, you know, Dan, if I miss something 2% for a long time, I can fix that. And he didn't ask how. I think he knew. You know, doctor, it hurts when I do this, and what does the doctor say? Then stop doing that. And in this case, I would say maybe they need to add 2% to their estimates. We think that they're probably going to miss this low again because I don't think they've changed any way about doing their estimates. And one of the reasons is this. This is the litter size before and after PEDV. And you can see we were going about 1.9% per year. The blue lines here, the blue observations represent since actual USDA estimates. And the question I ask is, how did PEDV permanently impact the genetic capability and management capability of U.S. hog farms to produce pigs per litter? Because this graph says it did. PEDV came along and we went from right at 10.4 down to here, and we never got back to the line. And I'm asking, they're the same sows, they're the same managers, they're the same systems. Now I know we had a little lingering impact of PEDV, but why did we not move back to where we would have been otherwise? And I don't get a very good answer for that. Now, I will tell you this. Had USDA accounted for their shortfall in the pig crop by adjusting the litter size instead of adjusting farrowings, the litter sizes would look like the red there. Okay? And that makes a whole lot more sense to me. And so we're using the litter sizes in red instead of the litter sizes in green for our forecast. We think we're right on that, and when you do that, you end up with plenty of pigs in 2017 as well as 2016. We'll get to that in a moment. In addition, we also have to account for some more pigs coming from Canada. Mandatory country of origin labeling finally went away last fall, about a year ago right now. And so it took away a roadblock for bringing pigs from Canada. Now their plants need hogs to stay there, and they're going to fight for them, but there's still more of them coming to the United States. Actually, feeder pig imports have not been quite as big as we thought they would be this year. They're still up 25,000 head from a year ago, and we think they're going to grow into 2017. Market hog imports are quite a bit lower this year because of a couple of one-off situations: a labor shortage, a labor stoppage in Quebec, the closure of the Toronto quality meats plant last year that pushed hogs south. But what do you think is going to happen when we open a plant in Michigan the second half of 2017? I think we're going to get a lot of market hogs that are now going to Quebec out of Ontario that are going to come across the river probably into the United States in the second half of next year. And so we have a pretty sharp increase in those for the second half of 2017. It's something we'll be watching pretty closely. Now, will we have a place to kill them? The answer is yes, next year. This year, of course, the only thing we really got going this year was the Pleasant Hope, Missouri plant that has been slaughtering pigs. They're certainly not up to this rate. The Wyndham, Minnesota plant was a remodel of a beef plant, got delayed. It, from what we hear, won't open until February. Sioux City and Coldwater, Michigan are the big ones that come on next summer. Those are on schedule. The last I talked to them, the folks at Coldwater still tell me they think they'll kill a few hogs in June. We'll see if that happens. Is that still kind of in the mix, Carl? He can't say. They'll shoot him if he says. So, no, they wouldn't. They wouldn't do that. But summertime next summer, I think, is safe on both of them. They're certainly on schedule. They've made great progress on those. A little ahead of schedule. Yeah, that's what I keep hearing from Dan and others. Kind of the same thing at Sioux City. So it's a bit of a race between them, I think, but they'll be open next summer. The Prestige plant found a home in Wright County, Iowa. They are still saying that they're going to start construction late this winter, and they will be killing hogs in October of 18. I think that's really, really ambitious, but we'll see if that happens. And so we're adding, 6% next year, another 2% or so to slaughter capacity relative to last year's average. If we double shift the Sioux City plant by the fall of 18, we'd add another 2% or so to that. So we could see 10% more slaughter capacity by late 2018, early 2019 than we have now. Now, that's good. We clearly needed it. And this slaughter capacity crunch that we've been in has been a long time coming. It's proof, Tom, that if you say the same thing long enough, you'll eventually be right. We would have had a slaughter capacity crunch in 2013 had it not been for the drought of 2012 driving up feed costs. We'd have had a capacity crunch in 14 had it not been for PEDV. We got a packing capacity crunch last year for 1 week. We actually ran above slaughter capacity or right at slaughter capacity for 1 week. Of course, this year we've already been well over slaughter capacity, but here's where our capacity is going the next couple of years. And it's going to provide us comfort, but not a whole lot of slack, as you'll see here in just a moment. And right here is our forecast for this year. Slaughter in the little blue boxes. The actuals are the dark blue. We've ran above capacity 4 weeks. But notice where the orange bars for next year are. We've got growth in slaughter most of the year, and we're going to pretty much fill those two plants by the fall of 2017. There won't be a lot of slack there. Now that means that there's going to be lots of supply, but we have 1% larger population. We have some growth of exports. We still think we're going to be soft on prices in the fall of 17, but not nearly as soft as this year. One of the things that's kind of saved us the last few weeks has been your efforts to get hogs moved. These weights have stayed about the same since September 1st. A little bit of growth last week on barrels and gilts sold through the mandatory price reporting, but normally we increase weights almost 5 pounds during that same period. And this year they've been flat. That's taken 1.5 to 2% off of production. That has really helped the supply situation and kept these prices much better than they would have been. Kudos to all producers that have really kept current on their marketings. Part of it was prices were going down. There wasn't much sense in feeding them another week. But it certainly has helped the supply situation and left us in a position where just a little pullback in those numbers of ready hogs can get us a rally. And I think we saw the beginning of that in that last week. We saw the negotiated market go up by $3.50. That's a lot when you're putting it on 40. And that's a positive. I think that is leading into this. And we've said for 2 or 3 weeks that we were kind of on the cusp, we thought, of rallying hog prices. It's going to be a while before we get back to cost of production, but I think probably the worst of this is probably in. As far as pork production, we've set records for that. For all of those weeks, we set records for supply. And again, next year, we're going to be up here toward the 560 million pounds per week level. We've got growth in weights between now and next year that's going to add on to those numbers. The cutout value is kind of held firm here in the low 70s, been pretty positive. We could see that probably drop a bit here in December. But packer margins are wide. I think there's plenty of room there that they're going to probably start chasing some pigs and help us on the price side. Our supply forecasts for next year, you can see, are a bit daunting. I mean, we've got 3 to 4% in every quarter except the third quarter, and the only reason we don't have that much there is it has one less slaughter day in it than it did this year, and so you have to account for that. The year up 2.7%, 32.4 million hogs in the fourth quarter of 2017. We have not changed those forecasts a bit since then. Any deviation we've seen, and there's been about 565,000 more hogs slaughtered since September 1st than our forecast said, and that fits almost precisely with what we think we pulled ahead in those marketings in order to keep weights level during that time period. So we think that any deviations there has been because of a change in marketing patterns. As for prices, we had 50 to 54 on the net negotiated price. Of course, that's traded all the way down to 40. But right now, if you look at the futures, you're going to be right in the middle of that. If you look for next year, again, the futures are pretty much in our range. It looks like we may be quite low on our third quarter forecast, but We'll judge that after the December report comes out. For the year next year, 60.93, actually a little lower than this year. Now, that shouldn't be a shock. The year after the fall wreck is almost always worse. 99 was worse than 98. 95 was worse than 94. Okay, when you have this kind of situation in the fall, the year after is usually worse. And the real bad thing about the year after is you never have a chance in many of those years to lock in hardly any profitable hedges in that year afterwards. This year you do have that opportunity. You've got summer futures above cost of production for next summer. Now, do you lock those in or do you wait and see what happens? It all depends on your financial position. Many of you went into this thing with very strong balance sheets. I don't know how bad you're going to come out of it when we get to January, February, and finally get back to cost of production sometime this spring. You need to kind of judge that with your lender as to whether you should take any protection next summer, whether you can afford the risk of those summer contracts. But right now, they certainly are giving you some profits during the summer months. Okay, if I don't do a supply-demand diagram, they pull my union card with the Economist Union. I haven't done one in a while, so I've got to catch up. But I want to offer this to you just as an explanation of why this constraint is so important. In a normal situation, if we had an increase in supply, the quantity demanded and the quantity supplied would go up. The price would go down. Notice, demand did not move. Demand is constant here. Only the quantity demanded changed, which is the quantity variable. The price will go down and clear the market. Right? Now, the reality of our situation is that in the short run, our supply curve is what we call perfectly inelastic. We determined the number of hogs coming to market this week 10 months ago, or roughly 10 months ago when we bred the sows. There's a little wiggle room, but not a lot. We don't have a lot of extra space out there that we can feed them another week. We're not like the cattle feeders that can say, oh, I don't like the price, so I'll feed them another week, and the cattle get bigger and the price goes down further. All right? That's cattle feeder mentality, and thank God you didn't have that this fall. You did just the opposite, and good for you. All right? But the supply each week is pretty much fixed. There's not a lot of wiggle room. So you get the same kind of thing. If supply increases, you get the same kind of shift. But what if you have a constraint on the demand side? Packers can only kill this many hogs. Well, there is no demand curve on past that quantity. All right? It has a kink in it, is what we call it. It's a perfectly inelastic portion of the demand curve. And now you have a virtually perfectly inelastic supply curve lying right on top of a perfectly inelastic demand curve. And it's what we economists call an indeterminate price. There is no single price that clears that market. It's not like when those lines cross and you can point to the price and the quantity. This one, they're all kind of muddled up here. And none of these lines are known with certain. They're kind of fuzzy lines that everybody's kind of guessing at in the marketplace. That's just the nature of markets. But when you have an indeterminate price, then you just pick them. That's what happened in 98, and the Packers picked $10. All right? This year, to their credit, I think they've picked 40. And they've at least kept people in much better place than they did in 1998. And there were some real, in my opinion, serious political ramifications had they not done that. I think that hellfire and brimstone would have rained down on them from Washington, even with Republicans in charge, had they done that again. And I've been warning about that for several months in meetings with Packers in the room. I don't know. I think they were smart enough to figure that out. But this is the reason that this constraint is so important. Because if you get against it, there's not a definite answer to the price question. You can just pick them. You guys can't ship any fewer hogs. They can't take any more hogs. All right? It's constrained. It screws everything up. And so we need to keep an eye on this in the future and try to manage our business so that we don't get ourselves in these situations. We've been warning for several years, and finally it's come to pass. We haven't been hurt as badly as we were in 98. That's good, but let's learn from our lessons here. If we look at what happens in those situations, Packer margins have been record high. And when you hand the leverage in the marketplace over, that's what happens. These margins in 2014, nobody cared about because everyone was making money hand over fist during the PEDV surge. This one, They actually eclipsed the level of 1998. So it's been a great time for packers, and that's one of the reasons we're seeing 3 or 4 packing plants being built. Packer margins, gross margins, have been better over the last 4 or 5 years than they were before then, and people have expanded the packing sector because of it. Okay, so what can producers do? I hope the best thing that all of you have been able to do is lift your profitable hedges, okay? Because if you were in that position, that would be your best thing, and you are probably the one sitting over in the corner at this meeting saying nothing. Get hog schedules as early as possible. That's still going to be an issue for a while here. Take some protection on any rally. Our discussion about next summer is one of those. Buckle down on all your management efficiencies. You're going to get some tips here that are going to help you on some of that. Protect cash. Many of you are in pretty good cash position going into this. You got to delay all non-essentials, and of course talk to your lenders now and get them involved. Risk these forecasts. Number one risk is always a major export disruption. Okay, we got all these diseases: foot and mouth disease, African swine fever, classical swine fever, President Trump. This was President Clinton, and I marked that one out. I'm talking about trade disruptions here. I think he could be one. This is really a question for agriculture at the moment. I mean, certainly he's rattled some sabers about trade issues. I think there are some trade issues that need, personally, that need rattled. A saber rattled about, because I'm not sure we're always doing fair trade. We might be doing free trade, but maybe not fair. But agriculture has benefited from these greatly over the several years, and the focus now is going to be away from agriculture and on to jobs and those kinds of things. I got a feeling we may have some tough sledding here. And so this is a concern to me, of how disruptive this might be to exports. We'll see. If we get into any trade wars with some of our major customers, that probably wouldn't be a good thing. It still wouldn't be as bad as one of these disease outbreaks. Because if you do, I don't think he can push exports to zero. And foot and mouth disease would do that. All right, so it certainly wouldn't be that bad. Disease is a non-factor so far. We've had a pretty mild go so far this winter with PRRS and with PEDV. My visits with the veterinarians indicate that they're not terribly concerned about PEDV. PRRS is still out there, and of course, anytime you get a handle on PRRS, it mutates and off you go again. So it's always kind of an ongoing battle. But still, focus now is on the winter to come. Feed costs, we're in good shape for 16 and 17. I think, as I pointed out a while ago, I'd be looking at 17, 18 costs and saying, really, am I going to leave very much money on the table at the kind of prices being offered in the marketplace now? Demand growth in 17. Domestic is going to be driven by preferences and wages and income. Those are the two things that drive it. We've seen very good preferences over the last several years. I think they're still in play this year, even though we're down from the record levels of 15. I'm not terribly concerned about domestic demand. Exports, China, Mexico, the U.S. dollar. I put Mexico in here, and I didn't talk about them a while ago. The major concern with Mexico is a dramatic expansion of their domestic capabilities. We hear from the equipment manufacturers and builders that Mexico is probably putting in 200,000 sows. That's about 16-17% growth of their breeding herd. They have state-of-the-art plants in part of the country there that will process that product, and they have a free trade agreement with Japan. So they will ship loins and tenderloins and high-value cuts to Japan and keep hams and butts and those kinds of things there. The things that we're exporting to them now, they will keep those in their domestic market. So over the next couple of years, we're concerned about exports to Mexico in light of domestic competition there. So that's something certainly to watch as an issue. Pork packing crunch in the fourth quarter, it's here. That's certainly been an issue. Impact of competition for hogs the second half of next year. When those new plants come on, there's going to be some hogs that will be in demand, the ones that aren't committed somewhere, and there's going to be a little chasing hogs. We have put in about $3 or so impact of competition. My good friend Joe Kearns at Ames, Iowa, says he thinks it's going to be more like $5 to $7. So if that's the case, then we're too low on our price forecast for the fourth quarter of next year. But that's going to be something important to watch. Pork prices, if we fill the plants in the fall of 18. If those plants are filled up, you got 10% more head, and over the next couple of years you could add another 1 to 2%, 3% on weights, and so you could have 10 to, you make a case that you'd have 13, 14% more pork 2 years from now than what you have now. I can tell you that our markets cannot soak up that much product. Okay, I can tell you right now, unequivocally, that we can't do that at prices that any of us will like, and so that's certainly a risk issue.